Have you ever stopped to think about what happens when the biggest money players on the planet suddenly get a little nervous? Well, today we are going to follow a massive river of oil money, see what happens when it starts to dry up, and explore exactly where all that capital is flowing next. And let me tell you, it's a wild world of crypto promises and some really well-hidden traps.
Okay, let's just start with this number right here. $119 billion. Seriously, just let that sink in for a second. This isn't just some abstract figure. It's a colossal wave of cash that was put to work by a very specific, very powerful group of investors, all within the last year.
So, who's writing these massive checks? Well, according to a report from Global SWF, all that money is coming from Gulf sovereign wealth funds. Now, to give you an idea of just how huge that is, we're talking about almost half, 43%, of all state-backed investment on the entire planet. Yeah, when this oil money makes a move, you better believe the whole world feels it. Which, of course, leads us to the big question we're tackling today. What actually happens when that gigantic river of capital suddenly slows down to a trickle? The fallout, as you're about to see, is a much bigger deal than you might think.
All right, so let's get into the nitty-gritty. How does a pause in spending from just one part of the world trigger a liquidity squeeze that's felt, well, pretty much everywhere?
You know, this chart right here really says it all. When nearly half the world's state investment originates from one single region, any kind of pullback doesn't just create a few ripples, it creates a massive vacuum. We're not just talking about a minor little market correction here. This is a huge fundamental shift in the way money flows around the globe. So who feels the pain first when this vacuum opens up? It's the industries that have basically gotten hooked on this endless fire hose of funding. We're talking about private equity, venture capital, a ton of AI infrastructure projects, and yep, even commercial real estate. These sectors are all built on getting huge long-term investments, and now their number one supplier is starting to turn off the spigot. And look, here's why this should matter to you, even if you couldn't care less about Wall Street. When a major source of capital just disappears, it gets more expensive for everyone to borrow money. This could be a huge reason why we're all stuck with these higher for longer interest rates that are putting the squeeze on regular businesses and families all over the world. Now, this tightening in the traditional markets creates a really fascinating side effect. See, when the usual safe places to park your money dry up, investors start looking for returns in some, well, let's just say more unconventional places. And this is where our story gets really interesting. This is what they call the search for yield. It's a classic story. When safe, predictable investments just aren't cutting it anymore, money starts flowing into riskier assets. And right now, one of the most tempting alternatives out there is the wild world of cryptocurrency, which seems to promise insane returns for anyone who's willing to roll the dice. To really see how this is playing out, let's zoom in and look at a perfect case study. It's a crypto project called Unitas, and it's being pitched as the perfect solution for this exact problem. So, the promise of Unitas is actually incredibly clever. It's designed to create something called market-neutral yield. Okay, think of it this way. It's like a system that makes money whether the market goes up or down. It's designed to give you steady returns without having to gamble on which way prices are headed. For investors who are just sick and tired of all the volatility, this sounds like an absolute dream. And this is why it's so tempting. Just look at these numbers. A nearly 800% gain in a single month. I mean, come on. When you see returns like that in a market where everything else is tight, it is almost impossible not to feel that pull, that urge to just jump in and try to catch that next big wave. But, and this is a really big but, this is where our story takes a very sharp turn. Because in the world of crypto, a rise that looks this incredible can often be hiding a very, very dangerous fall, especially when the game is rigged. This quote right here just lays out the cold, hard truth of these markets. You see, unlike the stock market, the crypto world is absolutely full of whales. These are massive players with enough money to push prices around wherever they want. And they do it all the time, setting up traps for smaller retail traders so they can cash in on their losses. And one of their favorite tricks is something called the dead cat bounce. Yeah, the name is pretty grim, but it's spot on. It's a short, fake recovery when an asset is tanking. It looks like things are turning around, and it tricks hopeful buyers into jumping back in right before the price completely collapses and continues its downward spiral. It's a textbook bull trap. So how in the world do you tell the difference? Well, think of it like this. A fake rally, that dead cat bounce, it's hollow. It's all flash and no substance.
The trading volume is super low, maybe even falling. The price never quite manages to break past its last high point. And momentum indicators, like the RSI, they just stay weak. A real recovery, on the other hand, has actual power behind it. You'll see trading volume explode and a clear, decisive break of that downward trend.
Knowing how to tell them apart is absolutely crucial for anyone navigating these markets. So let's break down a simple toolkit, some practical things you can look for to spot a fake rally before you get caught in the trap. Okay, here are 4 red flags you gotta watch for. First up is the ghost rally. Price is going up, but the volume is going down. That's a huge sign of weakness. Second, watch for the Fibonacci wall. That's when a rally runs right into a key technical resistance level and just stops dead in its tracks. Third, keep an eye out for specific bearish candlestick patterns right at the peak of the bounce. And finally, always check the momentum. If the RSI can't even get back to the neutral 50 line, that rally's probably running on fumes. And that brings us right back to where we started. In this new financial landscape, where a global liquidity squeeze is pushing everyone to hunt for returns in much riskier waters, you really have to ask yourself a serious question. Are you the hunter, carefully picking your targets and managing your risk? Or are you the one being hunted? It's something to think about. Thanks for tuning in.